Hey, what's up, everybody? Today I'm going to explain to you the child tax credit. I'm going to walk through an example of it and help you understand why you might not be benefiting from the full amount of the child tax credit. And I'm going to explain to you the difference between a refundable tax credit and a non-refundable tax credit. And the very interesting thing about the child tax credit is part of it is refundable and part of it isn't. That's why it actually shows up in two places on your tax return. Okay, so let's walk through this. Your tax return might have some complicated elements to it, but the first page of the tax return is a very basic math problem. It's going to take all of your income and add that up. There might be some adjustments that you get to take to subtract off of that income. Then you get your standard or itemized deductions, which you subtract off of that income, and you arrive at your taxable income. Once you have your taxable income, you take your tax rate and multiply it times that to get the amount of tax you owe. Then we have to figure out if you have any credits or withholding that have basically already paid for that tax. And then we determine if you owe additional tax or if you get a refund. So there's a couple of things we're going to cover in here. One of them I'm going to very briefly touch on is why your refund doesn't matter, but instead the actual amount of tax that you owe is the number you want to pay attention to. Now, I do have another video that you want to check out about why I don't think you should be paying attention to your refund. But we'll cover that just very briefly in this video. All right. So with the child tax credit, let's explain the difference between a refundable tax credit and a non-refundable tax credit. All right. So in order to do that, I want to take a look. I'm going to put up on one side or the other right here a little bit of a whiteboard situation. So let's say that your taxable income is $20,000. Now I'm not going to do the math on these as far as the tax rate goes very specifically, but let's just say you get your taxable income and it is what it is, and now your tax on that is $5,000. Okay, the child tax credit will reduce the amount of tax you owe, and it's $2,000 per eligible child. And in our example, we're going to say you have 2 eligible children for the child tax credit. The maximum amount is $2,000 per child. So if your income tax is $5,000, we now do tax credits before we even look at your federal income tax withholding. Okay, this is before you're withholding from your paycheck. The $4,000, you can qualify for all of it, reduces your $5,000 tax down to $1,000 of income tax. So you owe $1,000 of income tax. That is your income tax liability for the year. If your withholding from your paycheck was $2,000, then you get a $1,000 refund because you've overpaid the amount of tax you owe by $1,000. Now, real briefly, right here, this is where I'm going to give you that quick tip, but you can also jump to that other video to take a look at it more in depth. Your $1,000 refund, okay? In this particular example, it happens to be the same amount as the amount of income tax you owe. You're liable for is $1,000, but you had $2,000 of withholding, so you're getting a $1,000 refund. You go, I got a $1,000 refund. My CPA is amazing. Well, let's say that your withholding had been $4,000. You would have gotten a $3,000 refund because your tax liability is still the same exact $1,000, but your withholding was higher, so you're getting a higher refund. Your CPA didn't do anything any better than before because you still owe $1,000 of income tax. That's your ultimate income tax liability, but you feel better because you got a higher refund. Well, that's pointless. All you did was you withheld more money of your own paycheck, gave it to the government for an entire year, and now you're getting it back. Okay? Jump to that other video. Ignore the refund. Pay attention to that line, the actual amount of tax that you're owed. Let's figure out if there's things we can actually do to decrease the amount of tax that you owe. And there are in different situations. It's not what this video is about, but that's the number you want to try to reduce as much as legally possible. Enough of that. Let's jump back to our example. Okay, so in that example, you got to take the full child tax credit. $4,000, $2,000 per kid, you have 2 kids. Now in this next example, let's say that your taxable income comes out to whatever it comes out to, and your income tax liability is $3,000. So that's what you owe in income tax. We're going to say that, okay, $3,000, well, the full child tax credit is $4,000. It's $2,000 per kid. But you only owe $3,000 of income tax. Therefore, this tax credit can only be $3,000. It's going to wipe your income tax down to 0. And you're going to say, well, what happens to the other $1,000? Okay, well, let's go down the line. Now, Our withholding is $2,000. The additional child tax credit comes down here as $1,000, and now your refund is $3,000. So a refundable credit can be given back to you whether you owe income tax or not. So again, you saw that the $3,000 of child tax credit reduced your income tax liability down to zero. And now you're still getting $1,000 of additional child tax credit given back to you. That's a refundable credit. Some credits can only offset the income tax. If the child tax credit were one of those, where the full amount, none of it was a refundable credit, you would have gotten the $3,000, wiped your income tax down to zero, and the other $1,000 would have just been lost because you didn't have enough income tax to absorb it. That's a non-refundable credit. But as you can see in this example, this is both, it's in two places on your tax return. You have the child tax credit of $3,000 in this particular example, and then you have the additional child tax credit of $1,000 in a second place farther down on your return after your withholding, and you're going to get that refunded to you. Okay, our last example is how you might miss out on part of the child tax credit. Okay, let's say your income tax liability is only $1,000. Well, you still qualify for a $4,000 child tax credit, but you only have $1,000 of income. Therefore, this tax credit is going to wipe out that $1,000, leaving you with zero income tax liability. Your withholding is still $2,000, but the maximum amount that can be refunded to you of the child tax credit is $1,400 per child. So $1,400 per child times 2 children in this example is going to give you $2,800. Now remember, the full amount is $4,000. You've used $1,000, meaning you still have $3,000 left. But the maximum amount that can be refunded to you is $1,400 per child. That's only $2,800. So we're going to put the $2,800 in. Your refund is $4,800. You technically lost out on $200 of child tax credit. Now that amount can be a lot higher. You can end up losing out on the full $600. The $2,000 versus the $1,400. That full $600, you can end up losing out on that, just depending on your situation and where your taxes land. Well, how do I not lose out on that? Okay, the only way to not lose out on that is for your income tax up here at the top, that $1,000, for your income tax liability to be, in this case, if it were $200 higher, you'd get to take that $200 up there, which would be $1,200. You'd still get the $2,800 at the bottom, and those two add up to $4,000. You're getting the full amount at that point. Well, how can you increase your taxes? Well, maybe you've got some stock that you could sell. Recognize that gain on that stock. Increase your tax liability by $200, but really in name only, because there's a $200 portion of this credit you weren't getting anyway. Now you get it, still wiping your income tax out to zero, still getting the same exact $4,800 refund, but you recognized income that now you never have to pay income tax on again. So that's just one quick example of how having a CPA who can help you recognize these opportunities and say, look, this isn't going to cost you anything. It's going to save you in the long run. How can we take full advantage of this and get some tax-free income that would have been taxed? Those capital gains would have been taxed. But now we've got them tax-free because we're utilizing a tax credit that we otherwise would have lost out on completely. So that's the difference between a refundable and a non-refundable tax credit, and how the child tax credit actually encompasses both of those things and can get split either all on one line and none on the second line, or between the two lines, and that's how that works. So I hope that helped explain this as best I could, and hopefully as simplistically as I could. My name is Brad. I'm the owner of Wooten CPA. My goal is to bring peace to your tax and finance responsibilities. One of the ways I do that is through these videos. Don't forget to subscribe and hit the bell so you're notified when other videos come out, and I appreciate you watching.